Okay, confession time. Have you ever opened your banking app, looked at your debt, and thought, wow, past me was feeling very optimistic? But guess what? If you're a homeowner, you may actually be able to use your home as a tool to consolidate your debt utilizing a HELOC or a home equity loan. And if you've heard these terms thrown before and simply nodded along like you know what they mean but really don't, that's okay. That's literally why we're here today. Because in this video, I'm going to teach you the difference between a HELOC and a home equity loan, when to use each one, and how each one could be a game changer if you're drowning in credit card debt. I'm Alex Gettlin with Achieve. If you've ever been overwhelmed by debt, confused by loans, or unsure of what your next financial move should be, this is for you. Every video we break things down simply, honestly, and without judgment, so you can make better choices with your money and move forward with confidence. Let's dive in. So first off, what even is home equity? It's actually pretty simple. Home equity is just the difference between what your house is worth and what you still owe on it. So if your house is worth $300,000 and you owe $100,000 on your mortgage, you've got $200,000 in equity. Pretty cool. That's your money sitting there in the walls of your house like a giant piggy bank that you live inside of and occasionally redecorate. And here's the cool part. You don't have to sell your house to use it. You can borrow against it. That's where a home equity loan and a HELOC come in. Both of these let you tap into your home equity. And here's the important part. Your house is on the line. So if you stop paying, your mortgage isn't just a bill anymore, it's a giant for sale sign. Use it responsibly though, and these tools can actually be pretty powerful. Let's start with the home equity loan because it's the easier of the two. Think of it like this. A home equity loan is basically a second mortgage. You apply, get approved, and then bam, the full amount lands in your bank account in one lump sum. Done deal. From that point on, you have a fixed interest rate and the exact same payment every single month until it's paid off. It's predictable and boring, and honestly, in personal finance, boring is beautiful. This is your I know exactly what I need and I need it right now option. A fixed expense like paying off $40,000 in credit card debt? Home equity loan is your guy. The downside, once that loan is paid off, it's over. If you need more money later, you're applying for a whole new loan. It's a one and done situation, like a disposable camera. Remember those? Now a HELOC, home equity line of credit, is a little different. And honestly, it's kind of like a credit card, which can be great or terrible depending on your self-control. Again, no judgment, just a warning. Here's how it works. Instead of getting a lump sum, you get access to a credit line. So let's say you're approved for $80,000. You don't have to take it all at once. You can take $10,000 now, pay some of it back, pull more later. You can borrow, repay, and borrow again during what's known as the draw period, usually around 10 years. And the good thing is you only pay interest on what you actually use. So if you've only drawn $20,000 of that $80,000 line, you're only paying interest on $20,000. Think of it like getting a full pizza, but only being charged for the slices that you eat. And then as soon as you pay for those slices, plus interest, you have access to the full pizza again. Pretty sweet. Wow. Pizza on demand whenever you need it. This is your, I'm not totally sure how much I'll need when I'll need it option. Renovating your house room by room? HELOC might be the move. The catch with a traditional HELOC, the interest rate is usually variable, meaning it can go up or down like the stock market, except now your house payment is playing emotional games with you. After your draw period ends, you enter the repayment period, usually around 20 years. Now you're paying back both principal and interest, and your monthly payment goes up. That jump can catch people off guard if they're not prepared. That jump in your payment can sneak up on you, like finding out your favorite streaming service just raised the price. No fun. Pro tip, some lenders now offer a fixed rate HELOC, which provides the flexibility of a credit line with the stability of a locked-in rate. Basically, it's the peanut butter and chocolate of home equity loans. Definitely worth asking about. Okay, this is great, but how do I know which one is right for me? Well, it depends on your situation. I know, it's not the simple, well, just tell me what to do answer. But let me make it simple. You give me the scenario, and I'll tell you which option is better, okay? Okay, great. I owe $10,000 on a high-interest car loan. Home equity loan for exactly $10,000. Cool. How about I'm renovating my kitchen, and we're still deciding if we're going to upgrade our appliances, and my contractor says there's a 50-50 chance that we might have to fully replace the floor. HELOC. Definitely a HELOC. Oh, I know. I'm going to buy a ton of NFTs. What? Neither. That is a terrible idea. Do not spend any money on that. That fad lasted for like 20 minutes. What are you talking about? Right. Yeah. Good call. That's why I'm here. All right. So that's the breakdown. Home equity loan, simple, fixed, lump sum. HELOC, flexible, reusable, but watch that variable rate. And if you've got high interest debt sitting around, either one could be a serious upgrade over what you're paying now. If this helped you, drop a comment, subscribe, and share it with whoever in your life is still just making the minimum payments and wondering why the balance never moves. That used to be me. Doesn't have to be you. See you in the next one.